Hi, I'm Steve Van Metre and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday nights to try to make sense of a market still not making much sense. But we got a lot to talk about. We've got boycotts, infrastructure bills, trade wars, and oil. So let's start at the top, boycotts. So last night, China has gone on a boycott U.S. products. And yeah, it makes perfect sense to me. If I was them, I'd probably do the same thing. And it's really easy to do in China. Now, I've never been to China, but I've seen enough videos and read enough things about it that when you go to a store in China to buy something, it's probably made in China unless it's got an American name on it. So, for example, if you go to KFC, now it's pretty obvious that money's going to flow back to the United States. If you go to buy a Buick, it's pretty obvious you're buying an American product. Even if it is assembled, even if there are parts, the idea is boycott America. And like I said, it's easy because they don't import a whole lot of American goods. Meanwhile, it would be really difficult for Americans to boycott Chinese goods, because I'm sure if I went to the store, I would spend a lot of time flipping tags to see if there was anything actually made in America. In a lot of cases, probably not. So for us to boycott China would be very difficult. For them to say stop buying iPhones, stop supporting American companies, would be very easy to do. Now, President Trump this morning announced that there would be no infrastructure bill, at least not at the moment. There is a proposal to bring out a $2 trillion infrastructure bill, which is staggering because with $1 trillion deficits, I have no idea how we're going to pay for this. But usually these things are split over 10 years. So you can be adding $200 billion to the deficit. So you're talking 1.2 trillion or more. Crazy. And just because the Fed is going to cut back their balance sheet unwind, the government's still spending too much money. Nevertheless, he decided that would be put on the back burner until the U.S., Mexico, and Canada trade agreement has been passed, which Congress has not passed it yet. And I told you this before, it's really important to understand, just because we're having negotiations with China between the Trump administration and the Chinese, it doesn't mean anything. They couldn't make a deal tomorrow, and it wouldn't. Now, this is the one part about editing that I'm not doing. So I got to quickly put this away so we can't hear who it is. And if you didn't think this was live, it's live. Okay. Well, it's live in a pre-recorded kind of way. So anyways, he was not happy that the Democrats were pushing to maybe bring up the word impeachment again. And so Trump said, look, until you decide to put impeachment behind you and until you decide to pass the USMCA, then you can just forget about an infrastructure bill because I am not interested in it at all. So that was put on hold. And then last but not least, crude oil inventories rose today, which is a continuous surprise to the markets because they think growth is coming. They've sold this growth narrative so hard that they believe it. But it's not happening. We have now 4 straight months of slowing exports out of Asia. Well, you don't get economic growth when you have 4 months of declines. Anyways, the content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, my own personal capacity. Opinions expressed in the video that I'm going to do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. All right, so let's take a look at a couple things I've got for you. The first one is called the McClellan Oscillator. Now, it goes by the summation index as well, and I was paying, well, I still am, I guess I already paid for a subscription service that this became my favorite thing, and they don't send it every day, and it took me better part of a year to figure out where they were getting it from, and I finally got it. So now it looks like at renewal I can get rid of that subscription because I don't need it anymore. Because again, half the stuff when you buy these subscription things for market stuff, it's online somewhere. You just got to go find out. So what we're going to look at, and I'm going to show you in a better view, is the McClellan Oscillator offers many types of structures for interpretation, but there are 2 main ones. First, when the oscillator is positive, above 0, it generally portrays money coming into the market. Conversely, when it's negative, below 0, it reflects money leaving the market. Second, when the oscillator reaches extreme readings, it can reflect an overbought or oversold condition. Yeah, all right. So let's go here, and I've got this loaded. Now, if you wanted to find this, all you have to do is go to stockcharts.com. Up here, put in $NASI. So unlike a lot of other people who charge for things, and I don't, I'm just going to tell you how to get it so you can see how cool it is. Change this to weekly from daily. And then I like to look at, you have to go down here to the predefined range and select 5 years and update. And here you get the chart. And what we're looking at is when this crosses zero. Now we can put the zero bar in here. Let's see. Horizontal line, add zero. I don't think I can make it bigger, but let's see. There, it's this very faint green line. When the summation index crosses a green line, bad things tend to happen. Now, there are times it briefly crosses and the market rallies back. It's these deeper ones that cause problems. So you can go back to 2016, and there was that double dip there. It shows up here. Here's the big drop that we just saw in October through December of last year. And guess what? We're at a reading of it looks like 71.46. It crosses zero. It can tend to accelerate selling in the market, and that is coming really, really quickly. So adding to the narrative, is the market in a topping pattern or a bottoming pattern? Well, this would certainly suggest that we are in a topping pattern because the summation index should be at least trending positively above the zero band. Otherwise, I mean, if the market was in an expansion mode, if we're turning into a contraction, you would see a drop like this, cross the zero bar, and accelerate lower. Odds are that's what we're likely to see. Now, adding to that, this was posted on Zero Hedge just moments ago, and there is a boom-bust barometer. Didn't know that Bloomberg had one of those, but nevertheless, what it does is it tracks the ratio between the CRB Industrial Materials Price Index and weekly jobless claims. Now, they say this peaked back in mid-April and has sunk like a stone, and a similar sign a year ago foreshadowed the market rout in late 2018. So you can see that the boom-bust indicator was headed lower, market was in defiance, and then finally the market gave up. And now look how steep this is. I have, in fact, if the gentleman who came by my office this morning is listening, and I believe he is, he will note that I mentioned this morning that there is going to be a sharp drop. And here is one of the perfect examples of that. Is see how the boom-bust indicator is falling. It's not bottomed. It's probably going further. And that is a very ominous sign for the stock market for prices to head lower, which means that this move right here was indeed what's called a bull trap. It was designed to get investors to buy into the market who thought that the market's never going to go down again. This is the best time because it's going up and up from here. And it worked. I can tell you not only from feedback I've heard from people, but just things that I have witnessed. This is correct. People have jumped into this, but the economic data is saying the opposite. And when you lead people off of cliff, well, all of a sudden prices fall. And this is what the smart money knows that a lot of other people don't. All right, so we've got that covered. Let's see what's going on in the charts. So let me close some of these windows out of my view because I don't need them anymore. And on to charts. Get my system reset. All right. So the S&P 500. Let's take a look at volume using the largest ETF, symbol SPY for the S&P 500. You see volume has tapered off. And one thing I wrote about today is the reason we know this is a topping pattern is because not only do we have 1, 2, 3 tops, but every time it gets up to these levels, which is not shown on this, volume tapers off, which means there just isn't enough money to drive stock prices higher. There just is not enough trading volume, not enough interest. The price is too high. So what did we see here? We see rallies begin with a cross of the 50-day moving average and then are confirmed by tagging it and going. Well, it didn't tag it. It broke beneath it, hit support here, bounced up to resistance, failed there, bounced up, and is sitting under his 50-day moving average. This is generally not a strong position. You can see kind of over here, it was under the 50-day and then fell, and then over here got under and fell. So you can kind of guess what's happening. Now, the other way we can look at that, and we've seen this, but it's always worth looking at, is you can compare things to, say, lumber prices. And you can see that lumber is telling you that, yeah, pretty much, hey, stock market, you've got to come back and revisit your December lows and start flushing some of these people out that thought they were going to make a lot of money buying in here. Or what really happens is the retail public buys right up here because they think this is it. And the reality is it's gone off to the races. So let's take a look at, let's make sure we have how much time we have. 10-year treasury yields. Since 10-year treasury yields are headed lower, lumber prices are supporting that. They're saying, hey, look, lumber is saying, hey, yields, you've got some downward moves to go here. And let's clear lumber off of this. So here again, yields came down, hit support, bounced up, hit resistance, came down, hit support. Market got excited about a double bottom. It doesn't generally work that simple when it comes to treasury yields at this point in the game. And nevertheless, yields rose a bit and then hit this very soft level of resistance and then were rejected. It's going to tell us they're going to make another run back at this 2.356 level and probably go beneath that and then flush this market out. Now let's look at the 7 to 10 year treasury bonds. And here I've got that soft resistance or support zone. Well, it was resistance, but now it's turning into support. So the way you look at this, and let's zoom this out, is what happens at these levels is once something gains traction. So think of this level like a car and the tire, you're in some sand or loose dirt and your tires are spinning, trying to get traction. And all of a sudden it hooks, right? It hooks and goes, boom. Think of that as these support zones, okay? So here we have, it's trying to get traction, finds traction, boom. And if you look at this above this dotted purple line, when it gets traction, so you popped over here and then boom, it shoots up. When it gets that traction, it shoots up real quick to this 108 to 109 level. So we know this isn't coming next. So what happened? It crossed over here, didn't find some traction, fell below, got some traction, slid, got some traction, and now it's trying to gain traction right on top of this support zone. If it holds there, boom, you're going to see yields quickly jump up to here. And maybe beyond, maybe it'll hit here and come back down and then go, who knows? But it's finding support here, and that is very bullish for the bond market right now. What else do I want to look at? Oil and gas producers. Zoom in, please. So we had a bottom, and I said there'll be a second bottom. Sideways patterns are generally consolidation, going to see more selling. We got a bottom, double bottom. Investors got excited, drove prices right up into resistance, came back here, another sideways pattern. Again, this becomes bearish. And look at today, we have another weekly crude oil inventory build, gas inventory build. Market doesn't understand it because they don't understand that during periods of monetary decelerations, there's less money. So there's less money to buy oil, less money to buy gas. That means you spend less money. And even at that point, even if you wanted to spend it, you go and say, oh, it's how much? Yeah, I can't quite afford that much. Hence why you get inventory builds, crude inventory builds during periods of monetary decelerations. Just how it works. So what is this telling us? This is telling us that oil and gas producing stocks are about to revisit their February and March lows, and if broken, they're going to head back to their December lows. And we already know that's going to happen because lumber prices tell us it's headed lower. And there you go. I mean, we can zoom out to the 1 year chart and you can see lumber is leading oil lower. And if that didn't convince you, we could put on here, what is it, /FVX, I think. Oops. Huh. Okay, /FVX. Nope, that didn't work. So that was 5 year treasury yields. Let's see if we can quickly add it again. FV. Maybe I didn't need the slash. That's not it. What is it? There it is. Wonder why it's not. Ah, well, no, that's not right. It doesn't. I don't think that is the right security. Parameter I'm putting in is wrong. So let's move on. Anyways, let's take a look at emerging markets. They tried to get a little rally here. They found some sellers. And look, emerging markets are headed down to confirm this double bottom here. It potentially triple bottom makes this a very big buying opportunity. A break below here says that you have another big drop coming in the market. If that happens, it would again set up a huge buying opportunity in the mining stocks. And since we only have no time left, we'll have to get to the mining stocks tomorrow. Let's forget it. Let's jump in real fast. Let's take a look at silver. 2-year chart on silver says we go farther than 2 years. Here is silver. It's finding support way over here. Here, it's finding support right at this price point here, support here. Finding support, not resistance. Support at these two levels here. Failure to hold this. You're back at your 2015, 2016 lows, maybe lower. We'll see, but sets up big buying opportunity because it's going to drag the gold miners lower, and you get a beautiful pair trade, emerging markets, gold miners, silver miners, long bonds. You're on the right side of the trade. Until Friday, I'm Steve Van Metre. Bye now.